Hello everyone, I'm Nur Hashima. The catalyst for the global financial crisis were falling US house prices and a rising number of borrowers unable to pay their loans. House prices in the United States peaked around May 2006, coinciding with a rapidly rising supply newly built houses in some areas. The global financial crisis, or better known as the Great Recession, was a multinational financial crisis that occurred between 2007 to 2008. The crisis led to a severe economic recession, with millions losing their jobs and many businesses going bankrupt. We will look into more details of what are the causes that contributed to the financial crisis, and as well as the lesson learned and preventive measures in the next slides.
Hello Dr. Azra and everyone, I am Liz and I will briefly explain on the issue and impacts of 2008 global financial crisis. Let us take a look at the primary issue that causes the financial crisis, that is the subprime mortgages crisis. Subprime mortgages is a loan issued by the banks to the public with low credit ratings and charging them with high interest rate. Why bank give loans to those people without considering the risk of defaulted payments? Well, it is because in the early 2000s, the housing prices was rising and the housing market was booming, so bank thought that the housing market may give them profitable returns. So if the borrower defaulted the payments, they will still get the house or properties and resell the mortgages to the investors to continue the profit. During that time, many people took the subprime mortgages because everyone was thinking that they will make a large profit if the house increased in value. However, in 2007, the housing market was crashed due to the default payment from the subprime mortgages, and the bank had to foreclose their houses. Since the foreclosed houses has less value, many financial institutions lost their money as well, along with the homeowners. This led to the negative impacts to the financial market and the economy, and the global financial crisis began somewhere in 2008. Next, I will talk about the impacts of the financial crisis to the global financial market and global economy. First, the stock market. Okay, the financial crisis causes the stock market to decline, and most investors experience lots of losses, leading to the loss of confidence in the financial market. Second, a collapse in financial institutions, especially the bank. In this case, several major financial institutions were collapsed, and many banks required the government bailout to survive. Third, global recession. The economic downturn in the US rapidly spread to economies globally, which led to the global recession. Other crises like sovereign debt crisis, especially in the Euro countries, whereby they struggle to finance their deficits due to the economic contraction. And last and fourth, currency volatility. Increase in market and uncertainty result in the volatility in currency markets. During the financial crisis, a secured currency like US dollar and Swiss franc were appreciated, while currencies of emerging market and commodity-depending economies were depreciated. And that's all from me on the issues and impacts. I'll pass the presentation to the next presenter, Fasha. Thank you.
Hello, my name is Nafasha Linibito Omali. I will present about lesson learned from Global Financial Crisis 2008. We have 4 lessons learned from Global Financial Crisis. The first one is the systemic risk and interconnection. The crisis highlighted the global interconnectedness of financial institutions, highlighting the need for regulation intervention to detect and mitigate systemic risks. The second one is transparency and accountability. The crisis highlighted the need for increased financial transparency, enabling better risk estimation due to complex financial instruments. The third one, consumer protection. The crisis exposed consumer vulnerability due due to shoddy lending practice and complex product. And the last one is regulation and supervision. The crisis exposed financial institution regulation weakness, including lacking credit standard and lack of transparency in complex financial innovation.
The financial crisis that happened on 2008 have changed the world. It also showed us that we need to have a better preventive measures to keep our financial system safe. There's a saying goes by, adversity often paves the way for success and also for a better future improvement. So here's a few we can do to avoid such crisis to happen in the future. First, we would need a better rules and supervision. What do we mean by better rules and supervision is a stronger oversight. The 2008 crisis happened partly because there wasn't enough oversight of financial institutions. We need to make sure that all banks and financial companies are closely watched. Regulators should have the power and resources to enforce the rules and step in quickly if something seems wrong. And then we also need to improve the risk management. Financial companies should have better ways to manage risk. These include testing how they would handle tough economic times and keeping enough money in reserve to cover potential losses. By being prepared, they can avoid the problems that led to the 2008 financial collapse. The fourth measures would be to be working together globally. Global financial cooperations. Financial markets around the world are connected, so crises can spread quickly. We need better cooperation and coordination among countries' regulatory authorities. This includes sharing information and working together to manage risk. Monitoring global risks. International organizations like the International Monetary Fund (IMF) and the Financial Stability Board (FSB) are important for monitoring global risks. We need to support this organization and ensure they can effectively address emerging risks. Second, we would need to be more transparency and accountability. First, we need to have a clear financial product. Complex and unclear financial products were a big problem in 2008. We need to make sure that all financial products are easy to understand. Investors should know what they are buying and the risks that involve. Holding rating agencies accountable. Credit rating agencies failed to properly assess risk before the crisis. We need to ensure these agencies are held accountable for their ratings. This could mean a stricter oversight and penalties for mistakes and misleading ratings. The third measure is the ethical lending practices. A responsible lending. By giving loans to people who actually cannot afford to pay back the loan, that was a major cause of the crisis. We need to enforce responsible lending standard to make sure loans are given based on people's ability to repay them. This means that we need to carefully do the background checking on the financial background of the borrower. And then protecting consumer. Strong laws should protect consumers from predatory lending practices. Regulatory bodies should monitor, address any violation to ensure borrowers understand the terms and the risks of their loans. The last measure is educating the public. It is about a financial literacy. Educating people finances can help prevent future crises. We should implement programs to teach the public about responsible borrowing, investing, and saving. We also need to inform consumers make better financial decisions, which helps overall economic stability. As we wrap up our discussion on the financial crisis that happened on 2008, it is important to remember how deeply it affected our world. The crisis showed us the weaknesses in our financial systems and taught us crucial lessons about the need for better oversight, transparency, and accountability. In response, we have made significant changes to improve our financial system. We now have stronger rules to keep a closer watch on financial institutions and better ways to manage risk. Transparency has improved, making it easier for investors to understand what they are buying and the risks involved. Finally, financial education is key. By teaching people how to make smart financial decisions, we can help ensure overall economic stability and resilience. In simple terms, the 2008 financial crisis taught us the importance of keeping a close eye on our financial system and making sure they are fair and transparent. While it brought many hardships, it also gave us a chance to improve and build a stronger, more stable financial future for everyone. Thank you.